Prashant Khemka, founder with White Oak Capital, joins us. Prashant, good morning. Thank you for joining us.
Good morning,
Prashant,
my pleasure,
while
Nikhil.
there is very little reason to complain about the right, right. Well, great to have you. While there is very little reason to complain about how markets have reversed in last 10, 15 trading sessions, should now one be cognizant of the risk which are surfacing up, risk on inflation, risk on how cost is having impact on margins, risk on how globally central bankers are tightening the snooze, so to speak?
Certainly, Nikunj. Pleasure to be here, first of all. You see, markets still year to date, if you look at the broader market, is up 30%. The mid and small caps are up nearly 40 and 50%. So, despite this pullback of some high single digit percent or so, the markets have rallied very sharply from the bottoms about 18 months ago from the bottom. And some sections of the market, particularly in the small cap, particularly in areas where I would say governance or sustainability of growth is suspect, those areas are more susceptible. So, over the last few months, I think the sustainability of profits has not received as much attention as just the near term, right now, here and now growth has. So, what you're seeing right now is a little bit of a recalibration in the market as the corporate earnings have come out for the quarter. I think there is a reassessment of what uh, sustainable margins could be for some of these companies. Obviously, during the COVID and post-COVID time frame, there was, because of supply chain disruptions locally, domestically in India as well as globally, there was margin expansion because there was consolidation of market share to a great extent amongst the larger players in against the mom and pops or at the expense of mom and pops. Now, as the smaller players, unorganized players get back on track, their businesses, uh, and some of these supply chain disruptions also are causing raw material inflation. You are seeing the combination of those things having a impact, softening impact on margins. So a big, I would say, there's several. Obviously, in any earnings season, it's hard to generalize everything into a few comments. But one of the underlying themes that we are seeing is a lot of companies reporting muted margins compared to what would have been expected. So the street was expecting top line growth to be very healthy, and mostly companies are delivering that top line, but at more muted margin levels, which is coming as a bit of a negative surprise for this year. So that's primarily, I don't put too much emphasis on the tightening rates and whatnot. I think that's very well anticipated, has been very well anticipated for last 13 years that globally Fed would be tightening. I think we would see that in global markets. So global markets, equity markets globally are capturing that risk fairly well, and India is moving in tandem with that. And I don't see a big, US markets are close to their all-time highs. So I don't lay too much emphasis on that having much of an impact on the Indian markets.
One read into the credit growth which banks are reporting. I mean, frankly, if you ask me, the big surprise for me and the big delight for me is how banks are indicating that a famine has become a feast. NPAs are down and credit demand is up. Do you think banks are a lag indicator or lead indicator of economy?
I think they are a indicator of economy, or at least in this context. The commentary is very strong from almost every bank. They're expecting very rapid growth from year on in many sub-segments of their business units. They are expanding double digit, I mean, across board double digit, but even closer to triple digit growth. So they are more lead indicator, but the market's also lead indicator. So market's been up 100+% from the broad market is 100+%, small caps are up 200%. They are lead indicators. Question is which leading whether the market as a lead indicator was ahead of, let's say, banks as a lead indicator. So even if your lead indicator, you can overestimate the signal, and that is what I would say could be the difference between what the banks are saying and what the markets are reacting.
Do you see a significant portfolio allocation in the funds which you manage and which you oversee towards the internet and the new tech companies, whether it is a Nykaa or a Paytm or a Zomato or few more? Do you see that change and that migration happening at your AMC level?
See, certainly we are at very, very early stages of this so-called new age technology phenomenon in India. So this thing happened in the US some 20 to 25 years ago, starting from the mid 90s when the Netscapes and the Yahoos got listed. All this analysis and all this media hype and criticism and euphoria, all combination was, very much played out in the US in the late 90s, and I had the good fortune of managing US money at the time. So this is and then it happened in the in Chinese market about a decade ago or so. Now, if you look at the US, if you look at the Chinese market, these new age technology companies represent, anywhere from 15 to 25% of the overall market, and in other countries similar or even higher. In India right now, they are low single digit percent of the market cap. That is including, I'm including the companies that are in the pipeline right now and about to be listed in a couple of weeks' time. If you think back over before, let's say 6 months, there was hardly anything listed in this space, not even a low single digit, a fraction of a percentage of the market. So we are going to, over the next 10 to 20 years, I don't see why Indian market would be any different from what we've seen in the US and other emerging markets. And I would expect these new age tech companies to form, if I had to pick a number, say 20% of the market cap in some 10 to 20 year time frame, and we are just at the beginning of it. Now it may not be, I'm not suggesting it is the same companies that are getting listed today which are going to make up that 10 to 20% or 20% of the market 10 to 20 years later, because many of the NASDAQ companies that are the largest of the players today didn't even exist 20 years ago. Facebook didn't exist, at least not in the market 20 years ago. Google got listed in the early 2000s, right? And many companies that were very large companies in 2000 are non-existent right now. I mean, AOL was the largest of the companies, is somewhere buried under, one of the telcos which acquired it, AT&T or Verizon. It's skipping my mind now, AT&T, I believe. The Ciscos and of the world and Yahoos of the world, they're nowhere to be found right now. So there could be a lot of churn in this. And I'm not saying it's slam dunk, you invest in all these companies because they're going to get a lot bigger and be a lot bigger part of our lives in the market. But the space, the sector is going to be a lot bigger. And it would behoove any investment team like ours to constantly be on the lookout for opportunities. There'll be some greatest of opportunities like you've seen in these other countries. And then there would be disasters in there as well. And investment teams who are able to better distinguish between the two can generate a lot of wealth for their investors.
Good morning, Prashant. You folks use the discount cash flow mechanism to figure out what you want in your portfolio. You have time and again also said you are sector agnostic. You don't look at sectors. You have a broad portfolio. It's not narrow, but there is a bias towards private banks and consumer staples. But having said that, Prashant, I just want to ask you, given where the markets are, what's your big idea for alpha generation?
Certainly. So you rightly noted, across all sectors over the last, well over a decade that I have, led teams investing in India, be it at my prior firm or here. We've tended to have fairly good allocation. We've tended to find a lot of good opportunities in financials, private financials, hardly ever invested in government-owned financials. And we have tended to have good exposure in technology or IT services companies, predominantly in India, technology is IT services, but whatever is non-IT services also, we've tended to have good exposure in technology. Consumer staples, just to rectify the perception, consumers, while in the overall consumer space, we do have good exposure, but staples in particular, not as much, not as high. Having said all this, I would say to your more pointedly to your questions, as of now, also we continue to find great number of opportunities across sectors. If there are sectors where we struggle to find opportunities, these are again, sectors such as utilities, energy, telecoms, real estate. Unfortunately, these are some of the sectors where we struggle to find opportunity. Even commodities in general, while metals have had a very strong run, we've struggled to find any attractive investable opportunities. Given our philosophy and process and approach and focus on governance and sustainable cash flows and business models and scalability, we've tended to find more and continue to find even at this time more opportunities in private financials, IT services, healthcare, consumer more broadly, including staples. These are some of the areas where we, and chemicals included in pharmaceuticals, these are industrials as well. We continue to find good number of opportunities. IT services, mid-cap IT services has been for long a great area, fertile area, very fertile area for generating outstanding returns or alpha for us. But the risk of highlighting a single area is that one gets, should not downplay the contribution of all the other areas that I've spoken about. And we've somewhat been associated with, having generated or done extraordinarily well in mid-cap IT, if you will, which is the case, but also in all the other areas we've had, the team has generated very strong and identified very strong opportunities.
And if you look at the private financials, look at the blockbuster recent performance of ICICI Bank and of course IndusInd Bank. But just Prashant, want to take forward the IT services part. In August, when I was researching for this interview, you did make a case that while there has been a run up in the stock prices of the mid-tier IT companies, it's okay if you look at it in a year-to-date perspective or the rest of the IT pack, particularly the large caps. Do you still hold on to that point of view? Because we have seen a considerable run up in share price, and now you are seeing margins also come under pressure. Look at the high attrition rates, for example.
Attrition rates is a concern, but I'll come to that in a minute. But look at what's the longer term case for this area, and we're not investing from a top down perspective. But let me tell you, 4 years ago, when we started White Oak, and since then, or 4.5 years ago, since I've had large exposure in this space, what we found was investors had sort of written off IT services space. I'm talking about 2016, 2017 timeframe when everything was booming as well in 2017. These were considered as, first of all, export oriented, and people were very gung-ho on domestic markets. Secondly, the fear was all this automation and machine learning and artificial intelligence and all will wipe out the need for, or not wipe out, but substantially reduce the need for IT services of the kind that Indian players provide. NESCOM anyways always guides for, and companies guide in dollar terms, high single rate, 7 to 8%. So people don't make the distinction between dollar growth and rupee growth, which I think is very, very critical. In India, nobody gets excited with 7 to 8% growth, right? If you, any company that doesn't grow double digit doesn't, excite investors. But in case of IT services, 7 to 8% dollar growth would very logically translate into low double digits or low teens rupee growth, which is a point people very naively gloss over, I believe, because there is a long term 20, 30, 40 year, and there's sound logical reason to believe going forward to expect that rupee would depreciate over time 3 to 4% range, given the inflation differential between dollar economies and Indian rupee economy. So if you think of a sector that's growing at low double digit or low teens pace, which very few other sectors are growing, then within that, you have a lot of individual companies which are executing a lot better, just like financial sectors. The overall credit growth is 15%, but not all financials are doing well. There's financials which are executing very well, don't need to name them, and are growing at 20 plus percent, not only growing at that pace, but growing very profitably in a risk prudent manner. Similarly, in IT services, sector that's growing at low double digits to low teens, there are individual companies that are growing at 20 plus percent on the back of very strong execution. And profitability of IT services is second to none. They're almost as profitable as consumer staple companies. The cash flow to earnings conversion is close to 100%, 90% on average for the sector. So people get focused on PE multiples, and that's what also I think combination of these things that people had written off the IT services mature sector with very mediocre single digit growth and focus on P multiples, that to suppressed P multiple led to a fantastic opportunity. And even today, while P multiples have expanded in absolute terms and relative to the market terms, when you look at cash flow multiples, these companies remain at a discount to the market and are growing much faster than the market. And there are a lot of other aspects that are a lot stronger than the average company in the market. Hence, we believe selectively, obviously, we own very few of these companies. There is a very huge universe of such companies. We barely own a handful. The team barely, a team has done a very good selection job. And we see that those remain multi-year, if not, longer than that, opportunities for us to be invested. Obviously, we'll remain sensitive to valuation, but as of now, the valuations are very much in their favor.
Do you see this combination again, where right now markets are pessimistic, valuations are reasonable, the sector may not grow, but some individual companies may grow, and they are still cash generating machine? What is that one thing which comes to your mind using your framework? Because what you are telling me is a 2016 success story. What we want to understand from you is that what will be the success story of 23 and 24?
Certainly. No, you're very right. See, 2016, 17, let's say, was an extraordinary opportunity. The returns from there have been phenomenal. We are not expecting, because there has been a certain amount of re-rating that has happened. We do believe further re-rating as well, no doubt, going forward as well, because we still believe that the value, the multiples, cash flow multiples I'm talking about, and on DCF valuation basis, there's still a lot of upside. But let me, without naming a company, let me say a particular XYZ company, which is today become a market darling and a large cap company, was in 2017 when we started, was a mid cap company, small to mid cap company, trading at 11 to 12 times cash flow multiple. On a metric of cash flow that we look at, which is excess ROIC cash flow, 11 to 12 times cash flow, as the market at the time was at 35 times. We believe this company merits to trade at a significant premium to the market. So at that time, there was hundreds of % of upside. Now, today, the market on the same metric that we use, excess ROIC cash flow multiple, something that we as a team have developed and focus on. Today, the market is at 45 times, which is okay, because a lot of markets around the world, their multiples on similar metric is in the similar zone. And this company has expanded its multiple, and it's now in the high 30s, right? But still, it is a company. So a lot of the gap has been narrowed. I don't disagree, but still there is, ways to go on the multiple, and the growth is superior to that of the market. Market's likely to grow on this metric that I'm talking about over long term in the low double digit range. When I say long term, let's say 5 to 10 years, whereas this company can still compound in 20% range. and I'm just taking one as an example, but there are multiple such broadly in the uh, same region, Nikunj.
Okay, Prashant, we're going to have to leave it at that. Running out of time. Thank you so much for joining us live today on The Market. Have a great weekend. Wishing you and the entire team a very happy Diwali.